Now, our program for today, obviously one of the most eagerly awaited ones of the year. This is a sellout crowd. We have three distinguished speakers today. I'm going to turn the program over to our board host, Patty Bedient, who is treasurer of the City Club, and she will moderate the program and introduce our speakers. Patty?
Thank you, Charlie, and good afternoon. I'm certainly glad I didn't have to tackle that long list of new members that we had, but as treasurer of the City Club, I'm equally excited to have those members too. One of the long-standing traditions of the City Club is that at the beginning of each year we have this economic forecast panel. And so in preparation for today's program, I viewed the videotape from last year's program. And on that tape, Kevin Kelly made the remark that a colleague of his at the bank once told him that an economist is someone who is good with numbers but just doesn't have the personality to be an accountant. Now, I'm an accountant, and I don't know if that had anything to do with the program committee asking me to moderate today's panel, but I can certainly tell you that although I'm no expert on personality, I think I can safely say that these three individuals do not lack for personality at all. Our panelists today are old friends of the City Club. They have appeared before the club each year for more than 5 of the past years. In fact, I think this is either the 7th or the 8th year that they have been participating in this program. And their popularity is certainly evidenced by the sellout crowd that we have with us here today. I will introduce them more fully prior to their presentation, but briefly they are, starting at the far end of the table, Dr. Kevin Kelly, President, U.S. Bank, Loren Wyss, Investment Counselor, and Dan Goldy, Consulting Economist. The format for today's program will be as follows. Each panelist will give an 8 to 10-minute presentation covering his given topic. During this presentation, each panelist will also include a forecast for the state of Oregon for the coming year. Following the presentations, we will have approximately 25 minutes for questions from the floor. And while we will be taking written questions, I will be giving preference to oral questions. So if you really want to get your question answered, you may want to consider using the microphone first. On the tables in front of you, you'll find some information which is a forecast on the state of Oregon's economy for the coming year. This sheet was provided by the State of Oregon economists and Hannes, and you're welcome to take this information with you today. And it is not necessarily in agreement with what the panelists are going to say today. Dan Goldy says guaranteed. The forecasts made by last year's panelists didn't differ that greatly among each other and really didn't differ that greatly from the so-called consensus forecast of the leading economists from the nation last year. In fact, with a few minor exceptions, one of those being the stock market crash this last fall, which some people would not say was necessarily a minor exception, the economy ran fairly close to what those predictions were made here a year ago. However, as I mentioned, this year, I think our panelists may have a little bit greater divergence of opinion. Our first panelist is going to be Dr. Kevin Kelly. Dr. Kelly received his Ph.D. from the University of Oregon in 1974. Prior to joining the bank, he held teaching positions at Lewis & Clark, Reed, and the University of Oregon. He joined the United States National Bank of Oregon in 1978 as an economist. In 1987, he was elected Executive Vice President and made member of the Management Committee of U.S. Bancorp. Last month, he was elected President of U.S. National Bank of Oregon and a member of the Board of Directors of U.S. Bank. Congratulations, Kevin. He has served as Vice Chairman of the Governor's Council of Economic Advisors and President of the Portland chapter of the National Association of Business Economists. He has served on numerous civic and community boards, and he currently serves as President of Pioneer Courthouse Square and is a member of the Portland Planning Commission. Kevin will address the forecast for the national and the regional economy in addition to his forecast for the state of Oregon and briefly touch on the outlook for agriculture in the state. Kevin?
Thank you. That's just a couple of things to do in 8 minutes. I was looking to start with for just a general description of what has happened. And I my economist told me that, in fact, there is a description of it. He said that the last year in the economy looked a lot like Columbus's voyage. When he left, he didn't know where he was going. When he got there, he didn't know where he was. When he got back, he didn't know where he'd been, and it was all financed by foreign capital. That's probably a pretty good description. In fact, if you go a step further and just look at what's happened in the last 3 months, and you take a contraction of the money supply, a tightening of fiscal policy, the record plunge in the stock market, and leading indicators going down for the last month. If 10 years ago when I was teaching college I had given that scenario to a student and he didn't tell me there was going to be a recession, I would have flunked him. I'm going to tell you there won't be a recession, which I guess is the advantage of becoming president and not an economist. We may get close, but I don't think we'll have the recession in 1988. The reasons for that is all the things I've just ticked off, all of those negatives in terms of the economy are really, other than the stock market crash, no flash news. They are going to have an impact on the economy. They're going to affect, first, consumers. Secondly, they are affecting government spending. So consumption will drop in terms of its rate of growth, and government spending will slow down in terms of its rate of growth. However, again, that's not flash news. This, for years, was a consumer-led recovery, but it wasn't this last year. 1987's relatively good year in terms of the economy didn't come because of a huge increase in consumer spending or in government spending. In fact, quite the contrary, they've been slowing down for over a year. The impact came from very other sectors, one being export trade. Manufacturing employment picked up dramatically this year, and capital investment picked up dramatically this year. Those are in fact likely to be affected in exactly the opposite direction by the last month's activities. If you think of what's happened, we've had interest rates fall and in fact reverse their direction. Interest rates were tightening for all of the summer months, and it looked like we were going to start getting pressure on investment spending. The dollar has fallen rapidly. Both of those, with the coincidental pickup in Japan of quite a bit of consumer activity, have kept the trade sector looking very positive for the future next couple of months and next couple of quarters, and it's picked up the notion of capital investment for the rest of at least the first half of this year, probably into the second half of this year. So what we've got is the factors that were growing in the economy have been boosted. The factors that were slowing down in the economy have been slowed down. Does that mean no recession? Well, it's a little bit of a problem because the consumer spending is the elephant in the picture. It's 3 to 4 times any of those other sectors, and so it's going to depend entirely on how consumer spending goes up or down in the next 6 months. I do not see consumer spending falling off the cliff. In fact, I think it's just a slowdown in the rate of growth as we experienced at Christmas. Christmas was still a positive growth rate, but it was not a terribly strong growth rate versus a year ago. That does leave us with sort of a picture of a man hanging on the edge of a cliff. He's not strong enough to pull himself up over and start the growth or start the activity going in the economy, but thus far he has enough strength left in him to keep him from falling off. That's exactly sort of the situation I put the economy in for the coming year. We just hope that somebody doesn't step on his fingers in the next couple of months, but he or she is hanging on in terms of the sectors that are adding to the economy, and there's still enough negatives that we're not expecting any miraculous recovery in the next couple of months. So we're looking at muddling along is better than average description of it. Interesting comment is, how does that affect Oregon? Because a lot of people may not know it, but for the first 10 months of this year, Oregon was the 7th fastest growing state in the country. That's a relatively surprising statistic when you live here. It's kind of hard to believe it, in fact, but November over November, the most recent numbers, our employment figures are up 4.3% for the year versus a national number of 2.7 or 2.8%, significantly above the national average. Oregon and Washington, and in fact the region in that sense, both growing at rates in excess of 4% in terms of employment. So that we've had an exceptional year. Why? Exactly those sectors I mentioned that had taken over the recovery are dominant in Oregon. Export trade, we have about twice the national average of reliance on trade sectors. And many of those are commodities which have benefited from the last year. Lumber and wood products, paper, even agricultural products have gone up because of a change in the way the government deals with the support prices and just general pickup in export activity and the drop of the dollar abroad. So that Oregon looks, at least in the past, looks very good, looks probably relatively stronger than the nation next year. Now, you've got to put that, again, with the fingernails and whether somebody's going to step on the fingers. I don't see Oregon surging in the immediate future, but nonetheless, it probably will outperform a relatively weak, anemic national economy. What are the numbers? I guess national economy, I think GNP growth is likely to be in the 1.5% range. At times, they've even called that a growth recession, which is a funny sort of term. What it really means is the rules of thumb economists use is less than 2% growth, you're probably not going to sustain your unemployment rate. You're probably going to have a rising unemployment rate. We're going to be very marginal, I think, nationally with respect to that. We will probably see some increases in unemployment, but it will not be, in my mind, 2 quarters of negative GNP, which would be a rule of thumb for a recession next year. In Oregon, we'll do slightly better than that. We'll continue to lead to some degree because of the dollar and because of lower interest rates. Our sectors of the economy that are doing well probably continue. We are not big producers of consumer goods. With the exception of a few clothing companies and shoe companies, we do have an awful lot of capital producers in this state, and we have a lot of commodity producers, and many of them are going overseas. So it really is a picture that is not all negative, but is certainly not going to be a rousing year. I think I mentioned last year that if you liked 1986, you were going to like 1987. I wish I could say that again this year. We're not going to have another year of 1987. It will be slower, but I don't think it's going to be negative. I think it's going to be generally a positive environment for Oregon, but not enough that anybody's going to be shouting from the rooftops. What are going to happen with the other numbers? I think inflation's moderately going to rise, moderately, 4 to 5% ranges, and rising throughout the second half of the year. I think the slowness will come in the first part of the year so that we'll see interest rates flat to weak in the first part, but then rising again somewhat in the latter part of the year, if the economy does make it. So it's generally a boring forecast from that standpoint. It's not too far off the consensus forecast, although I was very impressed that they were able to tell you the exact quarter in which the recession is going to occur in this. I've been waiting to read that myself. We will have a year that I guess we can look back on and say, again, we outperformed, but the outperformance is not something we're going to be writing to our relatives about. Thank you.
Thanks, Kevin. Our next panelist is Loren Wyss. Loren is a Portland native. He has been an investment counselor for over 20 years, managing pension, profit sharing, and mutual funds, which totaled several $1 billion. Loren obviously had a lot of fun this fall with the stock market crash. He has also been a radio commentator and a member of both the Board of Higher Education and the Board of Directors of TriMet, where he currently chairs that board. Loren will cover the economic forecast for investments, primarily stocks and bonds, and he too will give his outlook for the state economy in general. Loren?
Thank you, Patricia. We're very proud of Kevin, I should say, particularly this year. We knew that an actor could become president, but we didn't know that an economist would be taken seriously by a bank. Hearing a summary of what we said last year, it's pretty clear that our agreement was about as broad as the trade gap and about as close to the target, I think. I'm afraid that Dan's prediction that the spotted owl would outlive the prosperity of Oregon's mill towns was probably the best guess that any of us made. And the dimness of everything else that we said, which Pat, in trying to recall, wasn't able to comment on should be a reminder, if you're going to be wrong, you don't have to be boring. Well, one of our problems the past few years, I think, is that almost all of the years have ended and the new ones have begun looking very similar to the previous one. For instance, I found this on my desk, a January 5th edition of Wall Street's favorite economist, Ed Hyman. And it says, for instance, January 5th, the dollar closed out the year on a sour note yesterday, falling sharply to a new 6-year low against the West German mark and other European currencies. Traders sold dollars in response to November's record-shattering trade deficit. Meanwhile, gold prices rose by $14.60 an ounce. Stock and bond prices sagged. Bank failures were at post-depression highs. Christmas sales picked up a bit at the end, but overall remained below original expectations. January 5th, 1987. That's the way it looked a year ago when we met, and in spite of all of that, we came through, I think, with quite a good year. So making accurate predictions has become more and more difficult when the velocity of change is so great. I would warn you that a year that begins with Nancy Reagan having to cancel her appearance on Grand Ole Opry with only a single day's notice, we should be ready for shock and surprise this year as well. It's clear that 1987 will be remembered in economic history for the October 19th 507-point stock market crash. More importantly, I think it'll be seen as the year that we ran out of cheap goods and cheap money, not because of the crash, but because of a combination of conditions that led to the crash as well. From now on, I'm afraid things are going to get considerably tougher for American consumers and taxpayers. First, the market crash. There are a lot of reasons that you've heard. Some of them were obvious even then. Briefly, I think, our long habit of saving less than we were spending had grossly swelled the amount of borrowings of all kinds. And foreign central banks, in an attempt to maintain the market share of their producers in our markets, had been keeping the dollar at an unreasonably high value by buying American dollars. Well, unfortunately, when they bought American dollars, they had to issue their own currency in exchange. In issuing their own currency, eventually they got around to supplying a substantial amount of new money into their own money systems. And without intending to do so, their economies began to progress rather sharply. So by the fall of this year, there were many more pressures on commodity prices than had been anticipated, and both those prices and the cost of borrowing money began to rise. Long bonds that had been yielding about 8% at the beginning of the year were yielding 10% by August, and they looked as though they would be considerably higher by year end. And against that, stocks, which had been going up for 5 years in an almost uninterrupted bull market, had grown so that their values compared to earnings and book values and dividends were at the highest fundamental level since 1972. The market had sustained itself in a number of ways, and its enthusiasm was still very high. There had been a massive inflow of money, the largest part of which had come from leverage buyouts and stock repurchase plans and takeovers, mostly by Americans of their own companies. Foreigners had placed a lot of money into the stock market as well, but not nearly as much as sometimes has been ascribed to them. It's the amount of money that foreigners have earned from our generous American consumers has been startling. Japan, for instance, last year had a $94 billion surplus. This year they had more like a $72 billion surplus. Those amounts far exceed OPEC's maximum amount of dollar surplus when oil prices were at their highs. So they had a lot of money to spend, and after having paid very historically high prices for their own stocks, some of it came here as well. But as interest rates rose, it became too expensive for most leverage and buyout people to continue their activities. And as each of the monthly deficits was announced, the holders of American securities found that their currency losses were greater than their market appreciation could be. Not only in stocks, I should tell you that this last year the Japanese bond investors found that they lost 42% of the value of their bond portfolios at the beginning of the year in a yen-denominated equivalent. British investors lost 38% and German investors 34%. both from a depreciation in currencies and also in the bond market. So finally, all of these things came together as people believed that there were other places that they could go with their money that wouldn't cause them such losses. And we lost 23% in one day in the middle of October, on top of a previous 14% decline, so that in the final collapse, the market was down 37%. There were some technical factors that made that market collapse worse, but the fundamentals were obviously the real reason for it happening. Since then, the market has rebounded quite a lot. I think today it's down, but as of yesterday, it had come back almost 2/3 of the decline, and that brought us to within 25% of the top that we had reached the third week in August. Some smart people are saying that that this market is like 1962, in which there was a severe stock market decline, which did not transmit into weakness of the economy. And people have been quoting Arthur Oken's remark, and probably Senator Biden's as well, that the stock market has predicted 8 of the last 5 recessions. I wish that they were right. But in fact, 1987 did see the end of the great bull market of the 1980s. A new generation of investors found after 5 years that you could get rich buying stocks, and their enthusiasm allowed the market to ignore weakening fundamentals for quite a period of time. Some of you who have been here at these sessions before will remember that I've recalled twice before in this century when the stock market went sideways for many years and then rather quickly tripled in value. That happened in the 1920s and the 1950s. The last couple of years I have been saying that we were in the midst of that. Until the market tripled from its lows, we could expect that the top had not been seen. Well, the market tripled from its lows at the point that it reached 2,600. It was able to make a little bit more than that, 27, 22, but by then it looked as though we were really out of fundamentals. I do believe that we will go through quite a long period in which the market establishes a sideways motion, much more like the 1970s than like the 1980s. In fact, until the dollar reverses its trend, until interest rates drop at least 100 basis points, and until there has been some sort of economic assurance, I think you should assume that the stock market has at the most 100 points on the upside and at least 400 points on the downside in its potential. After that, I would expect a long slogging period like the 60s or the 70s as values have to reestablish themselves. If I had to pick a time for the top to be reached, it would be a week from today when the November trade numbers will be announced. I don't know how they will look, but you have to realize that when the dollar has been as weak as it is, even though volumes increase, the amounts of relative values are not going to increase very well, and we are likely to show a substantial trade deficit of at least $16 billion. In the long run, I think we will be best off if 1988 is a recession year, and I think the odds are at least 2 to 1 that we will have one. Additional expansion after 5 years would mean that we would quickly run into higher interest rates and higher inflation rates and bring another sharper market correction. But I don't think we have to worry about that. I think instead that foreigners have been scared away from our market. They will not be available with that 15 to 20% that they have provided at the margin, which have allowed us to finance ourselves. And so I think that we have simply run out of money for an ability to keep up the kind of economy that we've had the last several years. If we do try to carry on, I would expect that we will have a substantial involvement without enough money for private investment. I see my time has grown short, so it's ended actually, Bob tells me. So I have to tell you that the Super Bowl indicator did work again with the old National Association team winning, which meant that we would have an up market for the year. Notice that until they went on strike in September, the market was up 30%, and then they went on strike and the market went kaput. This year the market looks down, so I have to take the American League team, whoever that may be. It is nice to know that in this topsy-turvy world, even with Nancy's problems, some things never change. Thank you.
See, I told you they had lots of personality. Our final panelist is Dan Goldy. Mr. Goldy is a consulting economist in Portland. He was director of the Oregon Department of Economic Development from 1976 to 1979. Until 1979, he also served as a member of the President's Advisory Committee for Trade Negotiations. Prior to that time, Dan held a variety of administrative positions with other governmental agencies, including the U.S. Department of the Interior and the Department of Commerce. He has also been involved in private business in the forest products industry. He has served on the board of the United States Chamber of Commerce. He's a member of the Board of Overseers of the World Affairs Council of Oregon, and he frequently writes and comments on economic matters for the Oregon media. Dan will cover the forest products and high-tech sectors of the economy in addition to his general forecast for the state.
Well, normally when you get three economists up here on one panel, you can expect at least 4 or 5 opinions. I'm sorry to disappoint you today. I'm not sure how many opinions we'll have, but I agree with a great deal of what I've heard thus far. Now, just in case you people are not in full voice today and asking questions, I'm going to ask my own questions and try to answer them. First question is that everybody's been asking is, was October 19th just a stock market correction? My answer, I don't think so. I think the fundamental problems that produced the stock market crash have not been resolved, and these problems are going to impact the economy in the months ahead, and the stock market will be further affected. Agree with Loren on that. Now, what are those fundamental problems? First, the U.S. twin deficits, budget and trade, which will confront us with $1 trillion foreign debt by 1990. Business Week said in a recent article that there are other countries that have gone into debt heavily, but we're the first country that's gone overwhelmingly into debt just to buy Japanese cars. The enormous debt accumulated by the less developed countries that they cannot pay off, that's the second item, looked for more payment defaults in 1988. Third, the fragility of the banking system, or the financial system. I'll broaden it a bit for Kevin's benefit. With record numbers of bank failures in the past 2 years when our economy was supposedly doing well, and with billions being set aside on the bank's books as lost reserves for uncollectible or dubious foreign loans. Fourth, a decline in our consumers' ability to purchase as real earnings have declined in recent years. Net savings have dropped to historic lows, and massive debts have been accumulated. And fifth, a gridlock on U.S. fiscal policy between the President and the Congress. The budget deficit agreement, in my opinion, was minimal, leaving the Federal Reserve Board with the entire burden of trying to achieve economic stability with monetary and interest rate policies. The Fed is caught between the contradictions of wanting higher interest rates to support the dollar and counter inflation, and lower interest rates to prevent a recession. Now, what happens if these fundamental problems remain unresolved? I think the dollar will decline further, foreign stock markets will take a beating, and ours will drop in anticipation of foreign fund withdrawals and greater difficulties in financing our budget deficits. Depending on the Fed's reaction, those events could produce a recession. Business is counting on 1988 being an election year, and Secretary Baker and Fed Chairman Greenspan's desire to avoid a politically disastrous recession to escape that scenario of a recession. The danger would be in a miscalculation by the Fed, which many think has already boosted interest rates prematurely after cutting them after October 19th crash. Unless our trade deficit improves significantly, I believe the upswing in the dollar in the past week cannot be maintained. Next week's trade figures are going to be quite interesting on that. Essentially, the U.S. will have to curtail consumption and increase exports to pay off the enormous foreign debt. The question is whether this can be done without putting the United States and the rest of the world into a deep recession or a rip-snorting depression. My forecast for 88, quite similar to Kevin's. At best, slow growth, between 1% and 2%. Worse, we go into recession. For the first 6 months, I expect GNP to be negative or very sluggish, less than 1.5%, and unemployment to rise. The second half of the year should see some improvement from the stimulus of lower interest rates and monetary infusions from the Fed, which will act to counter the recession or economic slowdown. I expect the consumer to curtail spending in early 88, especially for big-ticket items like appliances, furniture, cars, houses, and that type of thing. This could be offset to some extent by increases in manufactured goods exports plus the substitution of U.S. manufactured goods for items heretofore imported. We are now seeing the resurgence of manufacturing as a devalued dollar and investments in increased productivity have made our old basic industries more competitive in world markets. It is especially gratifying to those of us who never bought the idea of a post-industrial society where we would live on services alone and prosper by taking in one another's washing. With this as background, what's my forecast for Oregon's economy in 88? Oregon has been doing better, as you've heard, than the U.S. as a whole and the surrounding states. The principal reason is our great dependency on a manufacturing industry that some would write off or dispose of if they had the chance. I refer to the wood products industry. During the past 3 years, the U.S. has seen successive records in softwood lumber and plywood consumption. As the industry has prospered, the unemployment rates have come down in our downstate and east side counties, and the Portland metropolitan area, which is the service and supply hub for the state, has also prospered. During the past year, we have also seen an enormous increase, 27%, in export markets for finished softwood lumber. There has been a worldwide boom in housing construction, and we have benefited in part because of the lower dollar, but also because ours is the best quality construction lumber in the world. Even if the national economy slows down or slides into recession, Oregon can continue to do better than the U.S. as a whole because the wood products industry should continue to do well in 88. I could tell you why, what's going to happen in terms of market, but to save time, let me go on. If that's the case, what have we got to worry about? If the markets for our most important industry look good for 88 and beyond, why not lean back and enjoy the prospect? The problem is our propensity for shooting ourselves in the foot, or more accurately, letting the federal government do it to us. The Forest Service has now presented all their new forest plans for the region. And as we predicted in this forum last year, their proposal is to reduce the annual harvest by more than 20%, or 1 billion board feet per year. This is not because there is less forest resource or timber availability than there was when the existing plans were adopted. Rather, it's because they have been pressured to create more wilderness areas than the Congress would agree to. So in addition to the 2.2 million acres in Oregon and the 4.5 million acres of wilderness in the region containing over 50 billion board feet, they are proposing to reserve millions of additional areas for various purposes, such as spotted owls. A reduction of 1 billion feet of annual harvest from the national forest translates into a reduction of about 14,600 man-years of employment. It would also mean a loss of timber revenue to the counties in which the forests are located of approximately $50 million a year. Can we replace these jobs with high-tech industries and tourism, as many say? In the case of high-tech, my forecast is that high-tech may do a little better this year, but I think they will be affected by any slowdown in consumer spending and investment as a result of the stock market crash and the fundamentals that I was talking about. Oregon has missed out on the superconducting super collider, which we've also are not going to get the Semitech plant. And I've noticed that Nippon KK has decided to postpone its Millersburg facility. Nevertheless, I think that we have a tremendous opportunity, and the Governor's Science Council will be focusing our energies on what we can do in terms of research, scientific research, which can be a good long-range opportunity for the future, but it's long-range. So where does that leave us for 1988? Notwithstanding a rather dicey outlook for the nation's economy, I believe Oregon will enjoy a reasonably good year. Eastside agriculture may be hit by a serious drought, and our high-tech industries may falter if investments in new equipment and consumer expenditures are curtailed. But I believe a buoyant wood products industry, enjoying perhaps its second-best year on record, will keep Oregon from sinking into the economic doldrums. Finally, and this is just my personal guess because I have not discussed it with them, I would expect the governor will intervene at the appropriate time to prevent the adoption of forest plans that would wreak havoc on the state's economy and on its timber-dependent communities. And I think in that he will be joined by the Oregon congressional delegation that have no interest in seeing an economic disaster descend on us. Moreover, I think their intervention will be successful, for to think otherwise would doom the vision of an Oregon comeback and would deprive the state and the counties of the revenues needed for essential services. That's right.
Thanks, Dan. That concludes the panel's formal remarks. We'll now open up the program for questions from the audience, and our microphone is being placed in the middle of the floor. Please approach the microphone, give your name. If you want to direct that question to a specific panelist, please say that when you're giving your question. Otherwise, any panelist may volunteer to answer your question. If you wish to submit a written question, please use the forms on the table in front of you, and staff people will be circulating to pick up those questions. However, as I mentioned before, we will be giving preference to the oral questions from the floor first. Do we have a question, please?
I'm Ray Polani, a member of the City Club. I didn't really want to be the first one, but it looks like I will be. My question is this, and it's really addressed to all of the panelists. If the deficit and the trade deficits are the most serious problems, and if a lot of it is due to buying Japanese cars, what would the panel think of a 25-cent gas tax at the federal level devoted to deficit reduction?
Kevin, would you like to tackle that one first?
I guess two thoughts on that. First one is an issue of timing. Now is probably, given the forecast here, I see a number of people are leaving. I think it's to sell. So some of you may be getting beaten to the markets. I mean, given the forecast of the group, an increase in taxes right now is certainly, going back to any economic history, not a way to have a positive impact on consumption spending or any of the other aspects of it. In the long term, should we change our tax structure? I think we have to deal both with the tax structure, and I don't have any objection to some type of oil or gasoline tax within that structure. But I think we have to both change the tax structure and finally address the priorities of government spending. I see 5 years of government spending, huge surges without any what I consider to be clear national agenda or agreement on the priorities. We continue to go back and forth on defense versus health versus medicine and others. So that I guess I'd only address it in a two-pronged measure. But I am not against adding in a tax at some point, but not in the coming year.
You want to tackle that one? I'd like to comment just quickly in this way, that 25-cent gas tax might actually increase the sale of Japanese cars if they continue to outperform in terms of mileage U.S. cars. However, I think that the more reasonable reason for considering some kind of a fuel tax increase would be for conservation reasons. My concern is that we're heading right back into the old problem that we had in the 70s of overdependence on foreign supplies of oil, and that could and that's a factor in the tremendous trade deficits that we're piling up, and that would be the more reasonable reason for considering something like that, Ray.
May we have the next question, please?
I'm Linda Peters. I'm chair of the Standing Committee on Land Use and Transportation for the City Club. One of the requirements which counties and other local jurisdictions have to meet as they revise their comprehensive plans this year is an economic development process that begins with an analysis of the resources that are available in that jurisdiction, both in terms of land and labor and so on. One of the resources that all of us have in all our jurisdictions is what we now commonly think of as garbage or the waste stream. But there are materials in that waste stream that are mineable for various productive purposes. I wonder if Dan and perhaps the others of you would like to comment on what from local jurisdictions, from the state, and or from the private sector can be done to stimulate enterprises that, for instance, draw on recycled plastics to produce new goods, that kind of thing. And if we can come up with some set of incentives and stimuli, can we prosper by taking in one another's garbage?
You mean if not one another's laundry? Well, I remember as a kid in camp an old song that ended with the rhyme that with garbage I'll feather my nest, I think it went. The answer is, of course, that in a world that will develop increasing scarcities of basic materials, we have to do much more in terms of recycling, and we've got to do a great deal more about cutting down the volume. But the question of what we do with what we've got in the present circumstances is going to be a very hot and lively one, and as I see it, most of the areas are competing vigorously to make sure that the garbage gets put somewhere else.
Seeing that we don't have another question at the microphone right now, let me ask one of my own. There was a presidential task force that has been set up to come up with some recommendations for controlling the extreme volatility which we've witnessed in the stock market this last October, and it's supposed to deliver its recommendations today. Loren, I guess I'll direct this to you. Do you think that some type of regulation would be helpful?
Well, as I said, Pat, I think the main reasons that the market did what it did was because substantial excesses of valuation had been built in. A large part of that was psychological, and we've seen those kinds of manias in all kinds of markets in the past, historically. I think trying to find the devil theory of investment problems, just like the devil theory of politics, usually isn't very constructive. You find that you can change one thing and quite rapidly something else will be created. I guess I'm enough of a free market believer to think that if people were over-speculating and had created many new products that were mostly to enhance their own riches instead of those of other investors, and if they got what they deserved, then I think it'll be difficult for those kinds of products to be sold again. I think in general there could well be some things to control the option market, some other purely speculative markets, but I'm afraid that the marketplace is always going to be imaginative enough to create new ones if it wants to.
Kevin?
In fact, I'd like to second that. I was in the Far East at the time of the market crash, Taiwan, Hong Kong, and Tokyo. And if you look at the one market that decided to try and control it, the Hong Kong market, and closed, they had the most volatility, the steepest drop, and the most concern among investors. And there's fears now in that market that they may never get many investors to return to the market, for fear that if you can close a market without telling people or on a moment's notice, then I don't want my money in it. And the more restrictions we put on our stock market, the less likely we're going to have firms raising capital through the stock market. Second piece of that, if we are an over-leveraged society, we need to be encouraging capital raised through equity sources, not debt. So we need to go exactly the opposite direction and make sure that market is viewed as the most attractive a source to get your money in and out of the market, and an attractive source to raise capital, therefore.
I'd like to just add one thing. Don't disagree with them, but I think that too liberal margin arrangements in the market leads to speculation and uncontrolled losses on the way down, which wipes a lot of people out. And secondly, I do think that we're going to have to pay some attention to the kind of investment instruments that some stockbrokers put people in that were totally unsuitable for them at the stage of life they were in. And I think there's going to have to be some degree of regulation of the securities industry in that regard.
Okay, next question, please.
Yeah, I'm Jim Stewart. I'm the chair of the Business and Labor Standing Committee. I have a list of questions, but I will confine myself to one. Taking a slightly different tack than some things we've been on, there have been recent reports that unemployment by several measures, both nationally and on the state level, is down. Simultaneously, we see reports that several measures of poverty are up. One implication of this, of course, is that we've got a large number of working poor. How do we attack that sort of a trenchant problem in a time of slow economic growth? Anybody who cares to comment?
That's a pretty tough question. I guess the flippant answer is that some people said that the October 19th break was an unofficial attempt to narrow the gap between the rich and the poor in this country. And I do believe that there have been some attempts more on the state than local levels to make sure that the requirements, that the so-called means tests and overall net worth tests are put into play before certain availabilities of funds are given to individuals or to groups. I think that you have hit upon one of the toughest problems that we have in the whole way that federal dollars are distributed, in that too large a portion of the federal budget goes to pay people who really don't need it, who have extremely strong political connections and clout. One of the statistics that is the most dramatic is that the average American over 65 has $9,995 spent on him, the average American in federal programs. The average American under the age of 5 has less than $1,000 spent on him. I wonder how we are investing for the future in that. So I guess I don't have any real answer for you, but I sympathize.
I think there's an answer that may be coming down the pike that's already in train, Jim, and that is that the resurgence of manufacturing basic industries in this country that we have seen, essentially the middle class incomes by blue-collar workers comes from working in the manufacturing industries, the basic industries. As those industries have been squeezed out in the last 7-8 years, squeezed down, and we have substituted the services I was talking about, what we have done is ratcheted down the income, so you get a lot of working poor. Now what we've seen with a lower dollar and a considerable investment in productivity changes in these industries, basic industries, a growth in export markets, you see a resurgence in them, just as we do in the wood products industry in this state. And right for our purpose here in this state, I want to say that if you want to see more working poor, substitute tourism jobs for wood products jobs. Now, I think we ought to get all the jobs we can get in tourism and wood products, but it is certainly a bad trade-off if you're concerned about working poor.
One last comment. Dan addressed the unemployment side of it. The poverty side of it, a pet problem of most economists dealing with the poverty issue for a number of years, is the way we measure not just poverty, but poverty programs. All of the money, the vast majority of the money spent by the federal government does not show up in getting anybody out of the poverty line, because it does not show up in income. We measure the poverty line by dollars only. our poverty programs don't transfer dollars. They transfer food stamps, they transfer housing allowances, they transfer educational vouchers, they transfer all kinds of things, good, bad, or indifferent, medical care, but it's not dollars. So that we could double all of our programs on poverty spending and we wouldn't bring anyone out of the poverty line because of the way we define the poverty line. So that we've got a real dilemma. Even if we're doing incredibly well and spending lots of money on the program, we will not raise people out of the poverty line simply by definition because of the way we've defined it.
Next question.
Don Clark, member of the club. Right in step with the last question, your last several comments, are any of you concerned about the extreme concentration of wealth in the top 2% of the population in what I understand now is far excess of what it was in even 1929, and the enormous disparity between that wealth and the rest of the population?
Ravi, I don't know if you know, Don, if you have read Ravi Batra's book. He's the professor from Southern Methodist University who wrote the book, The Great Depression of 1990. But that's the argument he makes for why we're going to have a depression in 1990 that's going to make 1929 look like a child's play picnic. And he says it's because of the concentration of wealth. I don't think that the concentration of wealth is the issue as much as the growing lack of consumer purchasing power in the average citizen because real earnings have been going down in the last few years. I think that's the problem. Anybody who lived through the Depression of the 30s has to remember that the problem then is there wasn't enough purchasing power to consume what we could produce. That's the kind of problem we could get into again if we don't pay attention to the fact that the average citizen has to have enough income with which to purchase what it is that we and the rest of the world can now produce. And it is a problem. I wouldn't put it in terms of just the concentration of wealth because it tends to get invested. But it's how people earn their living and what kind of wages they can earn, and do the wages keep up with the rise in inflation? It hasn't been doing that. We're going to have to correct that.
In fact, I carefully make the distinction between wealth and income. Concentration of wealth is one thing, but generally this country has not been known as a country of idle rich, as many other developed countries had gotten to one point in time. In my mind, it is a much more important measure to talk about the diversity of your earned income than it is the concentration of wealth at any time. There's very, very poor statistics on concentration of wealth. There's a lot of debate as to whether that 2% number has been changing on the order of magnitude as to whether it has or not. Income, on the other hand, we have much better statistics on, and I think, as Dan had suggested, is a much more important one to focus on. Are we allowing more people to live off of their annual income in a better or worse fashion? And I think that's a much more important statistic than the wealth statistic.
Next question.
Kitty Wheeler, member. Given the crisis our state is facing in education, and most particularly now basic school support, and some talk of resurrecting the dead horse of sales tax, what are your thoughts on how this crucial financial need of supporting our educational system in this state is going to impact our whole tax structure and our state basic support?
I'm afraid that all of the polling shows that the one thing that every politician should avoid proposing is a, quote, new tax, unquote. So I expect that all of the brightest suggestions for facing our educational problems will be incremental taxes or user taxes of various kinds, which will probably be inadequate. I said several years ago that the obvious solution that we should consider was to make the defense budget dependent upon property taxes and the education budget in this country dependent upon U.S. government and U.S. income taxes. And so far nobody's taken my suggestion. Need to go in that way.
Very quickly to wrap it up, do any of the panelists have one thing that they could say this coming year? You've given us what you think is going to happen, but any major surprise that could greatly impact your prediction?
Kevin?
Go ahead, Dan. I don't have a major surprise.
That's good to know.
I mean, there's a series of things that can happen, but I don't have one single thing that you should be watching for.
I think that the strength in the American dollar would be an important surprise. I think it probably would allow us to refinance our deficit more easily than I expect is possible now. And I think that it would allow us to have only a short and a relatively shallow recession instead of the really big one that I think is probably going to occur.
Okay, Dan?
Well, I think the biggest surprise, at least to the business community, would be if given the fact that 1988 is an election year and that a recession in this year could be politically disastrous, if nevertheless the Federal Reserve Board permits it to happen. We said earlier on that we think there could be a miscalculation, but I think it would still be a big surprise to me if in the face of a sliding economy or a weakening economy, the Fed doesn't call out the troops and pump money into the banks and bring the interest rates down to prevent it.
Okay, in closing, I would like to thank our panelists for providing us with their insights for the coming year. It certainly has been an honor and a pleasure to have them back. And with that, we are adjourned.